How's it going, everybody? My name's Teylor Cline. I'm one of the scholars here in the Reach Your Peak Scholarship here at UCCS. I'm a management major here at UCCS. And I also work as a loan officer here in Colorado Springs. And so what we're going to be going over today, it was requested by the students, is a first-time home buying class. So I'm obviously a college student. I'm a senior, so I'm going to be graduating in May. But what I've been doing while I work through college, and what I've been really raised doing, is I was raised in a family of mortgage lenders. And so I know how to get a college student from college into a house and what we need to do to prepare somebody to get into a house. No matter what stage of college you're in, you should really start doing all of these, whether you're a freshman or especially if you're a senior and you want to buy a house, or maybe think, okay, I don't know if I can buy a house. Well, be sure to watch this video, this whole presentation, and we're going to talk about all the details, especially for a college student going from college and getting a house. And you can't even get a house while in college, but there are some specific situations and scenarios necessary for that. So we're going to talk about today, and we're just going to jump right into it. I'm live streaming this right now. So I'm live streaming it on Twitch. So if you see anything that might be odd or out of place, apologies. That my setup, the best way it works is I have to stream it to Twitch and then download the video from Twitch. So now with all of that out of the way, all of the intro out of the way, let's go ahead and jump right in about how you can buy your first home. And it's very important to note that it's going to try and take some work. And so what we're going to do to start off is we're going to contrast owning and renting. What are the pros and cons of each, and what is required for both? So we're going to look at this next slide here. There's also a little bit of delay, so if you ever see a delay between the visuals and what I'm saying, that's also kind of what's up here. So we're going to look at the advantages of renting. So the nice thing about renting is it's very short-term liability, very short-term commitment. So first of all, any damages that happen to the house are usually the result of your landlord having to take care of it. You don't really have to take care of it if it's like a broken washing machine or a pipe bursts. That's something that your landlord has to take care of. Or if a tornado hits the house, it's not your house, it's the landlord's house. Tornadoes aren't very common in Colorado, but it was the best example I could think of. Now, the other thing too is that you can have a less long-term commitment, because obviously a house, that's a lot of money, it's a big investment of time and finances. And so when we look at the less long-term commitment, you can have a rent as low as a month. Whereas for a house, you're usually kind of getting in there for a longer period of time, and it's a bigger dedication. And so now let's contrast that with the advantages of owning. So a biggest thing is building equity, and we're going to look at what in Colorado Springs even the equity in our area has looked like here in UCCS area. There's also tax benefits. So one thing that you can do is you can get a couple of tax write-offs when you own a home. Also, when you own a home, you can have a mortgage that the payment never changes. So you never have to worry, okay, is my mortgage payment going to increase? Because the principal and interest, which we'll also break down here in a second, will never change. And you also have the freedom to do what you want with your house. You own the house. You can do what you want with it. You want to make the interior pink and sparkly and, oh, this is so great, we want unicorns everywhere. Well, you're allowed to do so because you own the house, whereas when you're renting, you might not have such freedoms. Now we're going to touch on that first aspect again of building equity, and it's large importance because when people think of buying a house, they usually think, oh, I want to do what I want with my house, which is extremely important. It is one of the advantages. But what is the bigger advantage is the ability to build equity. Now, if we look at the screen here, all of these prices are in El Paso County for Colorado Springs. Now, back in 2012, a house was $164,000. So while we were all in high school, middle school, depending however old you are, that's houses were relatively cheap. And in 2019, as people started coming into Colorado, a lot more people were moving to Colorado. Housing prices jumped to $267, and so in 7 years they jumped $100,000. And now, since COVID, things have gotten even crazier. So the average home price in 2021 in El Paso County was $486,000. So if somebody bought a house in 2012, in 9 years they will have had a 196% increase in equity. They will have gotten the value of their house in 9 years, which is pretty crazy. And that's usually where most people get their wealth is from the equity in their house. And so that's why it's such an important thing to stress. For when someone's trying to buy a house, it's not necessarily always the house that's important. It is important, let's be clear. You want to like your house. But building equity is what allows somebody to not have to work for all of the money they get, not have to toil their entire lives for the money in their bank account. And so it's something to keep note of, and something to really realize is the real importance of owning real estate is being able to actually make money. It is an investment. Now, it is sometimes boring to talk about math, talk about investments. Boring, I get it. But it's extremely important. It is one of the most important things that'll happen for somebody even in the middle class. That's usually what separates the middle class from the lower class, is the equity in somebody's home. And so I know I'm talking about it a lot, but it is an extremely, extremely important concept, and especially for somebody to understand in high school and try to take advantage of right away, because the longer somebody doesn't own a home, the longer somebody doesn't build equity. And so it's something very important to note about why. Why do you really want to own a home? In my opinion, this is the biggest reason, coupled with the other reasons that we talked about in the previous slide. So we've established why we want to buy a home. We established the reasoning and the rationale. So now what do we do to get a house? So these are the three main steps to getting a house. Number one is pre-approval. This is everything to do with the loan and getting the loan ready for the house, because the loan is really where most people's money's coming from. Unless you have $300,000+ lying around, this is how someone's going to get the money for their house. Number two is home searching. So now you finally know what you can afford in a house, you know what you can get in a loan. Now you can go out and you can start searching for homes, and you can start seeing the homes that you want. And then number three is home buying. Now, number one is mostly what we're going to be talking about today, obviously, because I'm a lender. I'm not a real estate agent. And so I'm going to be focusing more on the lending side. But that's where, in reality, most of the work for buying a house goes into, because once you start home searching and you're pre-approved, it's far smoother sailing than having to get a loan when you go under contract and not having the loan ready, because that means you don't actually know how much you can afford, and you have to do all of that work all at once, and it kind of hits you like a train. So that's why we teach this too, is because this is just the smart way of trying to get a house as well. Now, what we want to do, even before we look at those steps too, is we want to know what fits your budget. Because if you can't afford a house, you shouldn't get one. You shouldn't be getting one, and you want to figure out a way that you can actually afford a house and not make yourself what's known as house poor, where all of your money goes into buying a house. Now, you can do that if you really want to start building equity, and it is possible, but it's smartest to start budgeting your money to get you into a house. Now, what we want to do is we want to see what breaks down the home costs to know how much we should be budgeting. Because when people think of a loan and how much it costs to afford a loan, they think of mostly rate. Okay, what's my principal? As you can see here, principal and interest. Now, principal is essentially you paying back the loan amount. That's the amount you're actually paying back to the bank. That's how much you borrowed. And that's the minimum amount you're paying in the end. And then on top of that is interest. So that's what rate is. The rate determines the amount of interest you're paying on the house. That's the extra money going to the bank because they gave you the money, and so their whole business goal is to make money back. That's part of it. But there's also two very important aspects other than principal and interest, and that's taxes and insurance. Now, these are separate from the loan, but are part of your home costs. Now, taxes are obviously property taxes. So where you own a house, the amount of taxes that are taken out by the government for you owning that house. And then on top of that is insurance. Now, we can look at insurance as, it's like car insurance. You need it for your house as well, and it is required if somebody's going to give you a loan from a bank to have insurance on the home. So these are the required home costs. There's also HOA too, depending on the area you buy in. It's not particularly common in the El Paso County area, but something to note on top of these home costs that will be considered when you go to buy a house. Now, a big thing to note about when you're budgeting too is a lot of people don't know, okay, do I have to have all of the money myself? No, you can use gift funds as brought up by this slide. Now, gift funds are essentially your parents or a relative gifting you money. They're giving you the money, and then you have free and unrestricted access to use it. It's a gift. Someone's never going to take a gift back, just as the same with these funds. It's not a loan. It is a gift. Your parents okay, here's the gift of this money. Then you can take that money and you can use it to buy a house. And many times that's how people can, especially first-time home buyers, can get a house, because it's usually pretty hard to save up for the down payment to buy a house. And so it is acceptable from family members, to be clear, is you want to get it from particularly your mom or your dad. Get a gift from them and then use it to buy your house. And then that's how you can use it to get a house if you're trying to buy it just by yourself, or let's say you go and buy a house with a friend, then you can use their parents because they're in the same boat as you. So now a couple of things is you do want to maintain a budget. We're going to now assume, okay, I can't get the gift funds, so I have to budget for it myself. Here's a couple of good apps that you can use to budget your money. Everybody's financial situation is different, so it's good to use apps like Intuit Mint or YNAB. Use those apps to budget your money and see how you can save to buy a house. And so now we're actually going to look at price range and properly budgeting. Let's say you have to get all of the down payment by yourself. Well, this is what we're going to assume and see how much you can afford in a house. So starting out, we want to see what's your price range. Now, if you have $6,000 in monthly income, you're allowed to spend half of that on both your home and your liabilities. So if you see here, $6,000 multiplied by 1/2 equals $3,000. So you can spend up to $3,000 per month on your home. Now, an important distinction to note is that this is $300,000 a month more accurately for all of the debts you have. So like, let's say, you have student loan debt. However much you have to pay per month in student loan debt, that's how much less house you can make or you can have per month. So let's say you have $150 in student loan payments. Well, now you can only afford $2,850 in a house instead of what was before $3,000. But so that's something to keep in mind. And we'll also talk about credit too, and the best ways to build credit with what kind of debts you want to have, so you're building credit and not having it in a way where you go into debt. But this is something to note for determining how much of your monthly income you can pay. It's also important to note that this is $6,000 before taxes. So this is gross. So the amount you afford in a house is, again, before taxes. That's what the bank counts. They don't count after taxes or after you take out money for your, let's say, your dental or your vision or healthcare or savings or 401k or whatever. Pre-tax. Everything else, that's your money. You can do what you want with it, but this is, again, pre-tax. And so now what we want to do to determine really how much you can afford in a house is let's assume you have $22,000 saved up. You only want to have about, and let's say all of your monthly expenses with that $22,000 are $5,000. So you want to make sure you have at least 3 months of reserves, just in case. Sometimes this isn't required by a lender to have, sometimes it is, but it's usually just a good financial goal to have, is to have this much in reserves, because you don't want the sky to fall in and you not to be able to pay your bills. Now, obviously, everyone's situation is different. This isn't hard and fast, but it's just a good tip to have. Hey, make sure that your money is smooth sailing and that you have some in the bank so you don't just completely fall in on yourself. So let's say you have that $22,500 and you need to save $15,000 a month. Now you want to make sure you keep $15,000 in savings, leaving you that $7,500 for a down payment. So how much would that get you in a house for $7,500 in down payment? Well, if you want to put at least 3% down, your ideal price would be about $250,000. And so that's something to note, is the amount of down payment that you have available is the amount you can afford in a house. So like, let's say we had the $22,500. You wanted to use a little bit more of that. Well, okay, you can go ahead and use a little bit more and afford a little bit more in a house. If you want to look over some more budgeting, this is a link to my mortgage calculator. It's not required, just a little plug on screen if you want to check it out. So now we know, okay, you can afford X amount of dollars in a house, at least in this example, is $250,000. And again, that $7,500 can also be a gift, as we talked about before, And we can also use a gift to afford even more on a house. So like, let's say that's how much you have saved up and you can afford for a house. Well, when someone gives you a gift, your parents give you a gift, well, perfect. That's now enough to be able to get the rest of even more amount in house. But now what we're going to talk about is getting pre-qualified. So this was all of what we were talking about was budgeting. And this was before you talk to a lender. This is you getting your own finances in order and your own finances straightened out. What we're talking about now is actually talking to a lender and seeing how much off rip you can afford for a house. And that's getting pre-qualified. So what goes into getting pre-qualified? Well, what a lender needs is to know about your identity, needs to know about your income, your assets, and your credit. And we'll go into the specific documentation, but this is kind of the general gist of it. We need to know that you are you're the person who is going to qualify for a loan, you're the person applying. You can't be applying for your grandma to get a loan. You have to apply for you to get a loan. If your grandma wants to get a loan, she's got to qualify. Okay? And now we look at income. So income, obviously, we need to know that you're making enough money to be able to afford it. So we look at the example, okay, $6,000 a month, $3,000 of that can be used for a home. We need to know you're making that $6,000 a month, because if you're not actually making that money, well, that doesn't help us. We're trying to make sure you can actually afford to buy a house. And then we want to look at your assets. So we want to make sure, okay, do you have enough to be able to afford the house? Do you have the money in the bank to buy a house? Are you getting the gift from your parents? Is that enough for you to be able to buy a house? And then credit-wise, what the bank wants to make sure is that you can take on debt and that you're trustworthy enough to give it back. So that's all of the steps that go into getting pre-qualified. So a couple of these are the specific factors that go into being able to qualify for a house. Number one is credit history and scores. Credit is a huge thing when buying a house, and it determines the rate and programs that you are available to be able to get. It's a large portion of that. So very important to note credit. Debt to income. So like we were talking about, the amount you make per month, that's your income, and then the amount of debt you have to that. So that's called your debt to income ratio. And so, okay, does the amount of money you make, how much of it is required to go to paying off debts? That's your debt to income ratio. And on top of that is what's known as number 3, the loan to value ratio. So how much is the house you're buying worth? And then how much is the bank giving you in a loan? So the loan is the loan amount. So as we talked about in the previous example, the value of the house is $250,000, but you're getting a loan of, what's $250,000 minus $7,500, which was your down payment. That's the loan to value ratio. So it would be a 97% loan to value. And then we're looking at liquid assets and reserves. So again, how much money do you have that's available to you to easily buy a house? How much do you have ready in the bank to go buy a house? And then job history. Are you 1099? Are you a self-employed worker? Or are you employed by a company? How reliable is your income? What kind of income is it? And where have you worked? Have you worked in the same field? Have you been moving around a lot? These are all things that can go into getting a loan. Now, I would never say, I've moved to a bunch of jobs, I can't afford a house. That's not true. Everybody's circumstances are different, so never just assume I can't get a house. Always make sure you're speaking to a professional about it, because they know more so how to be able to get into a house than an average person would, because that's not their job, which makes sense. So just something to keep in mind. So what affects my credit score? And we talked about credit is extremely important in getting a house. So 35% of being able to get a credit score is your payment history. So have you had maybe some credit cards that you've paid on, that you've used in the past, and that you've paid back? So is your payment history on time? And then 30% of it is amount owed. So do you have, let's say you have $5,000 of credit cards. Are you maxed out on your credit cards? If you are, that's going to negatively affect your credit score. 10% is credit mix. So how many different lines of credit do you have? How many different kinds of credit do you have? 15% of it is length of credit history. So this is kind of the biggest one that usually gets people out of college, is we don't have a long credit history. And so that can kind of hit us biggest, is because, some of us, I'm 21 years old. I can only have a 3 years of credit history, whereas someone who's 50 years old can have 30 plus years. And then 10% of it is new credit. So how often is lines of credit being extended to you? Have you just gotten new credit recently? That will decrease your scores, because now you've taken on more liability and you have to prove you can pay it back. So what we're going to talk about are a couple of tips for somebody in college to being able to raise their credit. And it's extremely important, so if you're able to take notes, please do. I don't think I have it in my slides here yet. So when we're looking back at credit, what you want to make sure you have is you want to make sure, bar none, this is required for getting a house, that you have 2 credit cards. Now, you don't want to use those credit cards as credit cards. Many people think, oh, credit card, I'm going to charge it up, holiday season. You need to absolutely make sure you're not using it as a credit card, not getting those high balance limits, because as we can see here, 30% of your credit is determined by that. But you want to use your credit cards as debit cards. And so you want to be able to make sure that any money you're spending on the credit card, you're able to pay off within the month. You always want to make sure you're doing that, and this will drastically raise your credit score. I mean, I'm in college, and I have a credit score in the high 7s just having 2 credit cards. And that's all I do. That's how I've raised my credit to be so high, and it did it in about a year. And so it's very important that you do this. Make sure you have 2 credit cards. Now, how do you want to use those credit cards? Again, you want to use them like debit cards, not like credit cards. And you also want to make sure you're only using 30% of the maximum balance. So let's say you have a $1,000 credit card. You want to make sure every month you're using up to $300 of that credit card, 30%, and then within the month paying it off. So you want to make sure you're never accruing interest on what you've used the credit card for, but every month paying it all the way off, and this will raise your credit dramatically. And it's very simple tips. Again, you need to do this with 2 different credit cards, 30% of the balance, pay them off every month. If you do that, you will establish yourself credit, and you'll put yourself far above your peers and having credit awareness and being ready with your credit outside of high school to maybe get, even if you don't even use it for a house, you can use it for a car loan, personal loan. Any form of loan, this is the way to best raise your credit. And if you want to know more about this, one, you can look at Experian.com. That's where all of these facts I'm talking to you from. Or if you have any more questions, again, all my contact information is right down there. If you want to learn a little bit more and in depth about it. So now we want to look at understanding the loan process. What goes into getting a loan? So step 1 is origination. So number 1, you apply. So you come to talk to somebody like me, a loan officer. We get all of the information we talked about before with your application, get all of that information. Then you get a loan estimate. So we estimate, okay, this is live, by the way, ELD Ollie test. I am filming this live right here. I'm, however, doing this for a scholarship. So for those of you watching right now, I'm, like I said, filming this on Twitch, trying to get some live viewers in here to get some interaction. So yes, it is. But so if you have any questions in the chat, feel free to leave it. And it'll help maybe with anybody who's trying to watch this to be educated. Now, so we have the application. We know your general information. Now we look to the loan estimate. Okay, how much is it estimated you can afford in a loan? And then after that, you get the documentation. We get to know more about your financial situation, prove what you've been saying, because it's great that you've said, oh, I make X amount of dollars. We need to prove you're making that much money. And then after we've proven all of that, then you can go under contract and then be able to be fully approved for a loan. So let's look at the documents to have prepared when you're going to talk to a loan originator. Now, number 1, you just need a valid government ID. American banks like lending to Americans, so you want to make sure you have a valid government ID. If you're in a different situation, there are other ways to get around it, but this is just something to note, is valid government ID, usually a driver's license or military license or passport. Most of those generally work. There are other ways depending on your situation, but those are some easy to access information. Then what you need to know is you need to have not just your previous years, you need previous 2 years of W-2s. Now, let's say you've just gotten out of college. Okay, I don't have my previous year of W-2s. Well, that's fine. All you need is your transcripts from college to prove, hey, I was a full-time student, and now I'm entering the workforce, and so I just got this job, and I can just get this house. So instead of W-2s, it would be your transcripts instead, or if you did work a job during that time, or 2 jobs for the past 2 years, or a couple jobs, or 1 job for the past 2 years, your last 2 years of W-2s. So in 2021, we would need 2020 and 2019, and then in 2022, sorry, my hair is always in my face. In 2022, it'll be 2021 and 2020. Or let's say you go and you be self-employed, you're a go-getter, you want to go out into the world. Well, you're going to need 24 months of 1099. So it's very important if you go out of college and you become self-employed. You will not be able to buy a house more than likely for 2 years. If you get 1099 income for 2 years, you won't be able to buy a house. So that's important to note of how soon your timeline is for when you want to buy a house. Now, with a W-2 job, you can quite literally, as long as the rest of your financial information allows you to, you can leave college and then go straight into a house with your job offer. You can literally get a job offer and get into a house before you even start your job, depending on your situation and what job it is and if it's full-time or not. But if you get out of college, go straight into a full-time job, and you have the assets saved up to buy a house, you can get a house. So it's something very important to note. Now, if you're 1099, what you will need is also 2 years of tax returns to go along, because we need to know, okay, how much are you taking out in taxes? Sometimes if you're W-2'd, you might need your tax returns, but it's not always required. And then we'll need to have 2 months of bank statements. So we need to see, okay, where's your money coming from? Where's other money going in? Because the other reason for 2 months of bank statements is we want to make sure that none of your money is coming from terrorist or drug money. So within the past 2 months, where's your money coming from? If it's a large deposit, it needs to be proved. Okay, here's where it's coming from. Oh, this is my employer. Oh, I sold a truck. That all needs to be proved to go into your documentation. Again, these are documents to have prepared. These will be physical pieces of paper, official pieces of paper you will need to get into a house. So a couple of things to know. These aren't specific pieces of paper you'll need, but you will need to know them when you're going into your application. One, you're going to need to know your last 2 years of continuous residential history. So everywhere you've lived for the past 2 years, essentially your primary mailing address, so that it can be tracked. Okay, you're the right person. We know that it's you who's making this loan application. Number 2, your social security number. Your credit has to be pulled for a true loan application to be complete. You do not have a full loan application until your credit's pulled. Anyone who tells you differently is lying to you, because a credit pull is required to really know what your loan application is. And it has to be per bank too, because I can't just trust that one bank pulled it. I have to trust that we've pulled it. That's the law. That's how it works. And then we're going to need to know the last 2 years of where you've worked in the associated fields. So again, if you're a student, we need to know, okay, I was a full-time student, that's what I do for work, and now I'm going into this job. That works just fine, that's fine. Or let's say you have been working somewhere for 2 years, we need to know that as well. And then we need to know the contact information to know that we can call that person and prove you've been working there. And for the job you might be going into, or the job you have, to say, okay, here's how much money I'm making. And prove from your employer that they verify the information you're telling us. So now we're going to processing. So now you've essentially done most of the work talking to somebody like me. This is all work essentially that we've talked to thus far of someone you talk to about a loan originator. They do the front end and the preparation for the loan. Now we go into processing, which is essentially, like it says here, it's the setup for the loan. It's the background stuff that needs to get done, because in a loan there are a lot of different parties involved. As here it says, we set up the file by ordering third-party services such as appraisal, and it's not just that, it's homeowner's insurance, it's title work, it's flood, it's all of that other stuff. And then we get it prepared to be looked at by an underwriter. And so underwriting is where a file is then scrutinized. So then we have to figure out, okay, is this eligible to get a loan? And so that's what underwriting does, is they're the people who really are essentially the gatekeepers for loans, but they make sure that your loan is actually qualified to go to the bank or to be bought by a specific bank, wherever the loan is destined to go. It's their job to make sure that it's all ready to go to be bought by that company, so that you can get a loan. Because if we just assume you can get a loan and then we try to get the company to give us money and they don't give it to us, well, that's a big problem, because we need the money to get you into a house. And then there's step 4, which is closing. So you get something known as a closing disclosure from the lender. It has to be issued at least 3 days before closing, and then this essentially gives you your final numbers. Here's all the numbers involved. Here's how much you're paying at closing. And then you have to sign. And then once you've done all of your paperwork at closing, at the title company, well, then you're ready to go. But now we're going to go into understanding closing costs. So this is a big thing to talk about. Really, this is where we get into the reality of budgeting. Because at first we talked about, okay, you only need $7,500 to get into a house. And that is mostly true. But what we have here is what's known as closing costs. Closing costs are a big, big, big cost. Not big as in like they're a large cost, but it is something that most people don't budget for and they need to be accounted for. Because if you saw 3% to get into a house isn't a whole lot depending on the house you're trying to get into. So what's everybody's fuss of trying to get into a house? You know, if you had $7,500 saved getting a $250,000 condo or townhome, well, that's pretty easy. I can get my parents to give me, $7,500. Now where it takes a little bit more work is closing costs. So as you can see here, this is a breakdown of all of the different costs that go into the loan that a person has to pay for, because these are different costs, not only with the lender, but also with like the title company and with the appraiser, and costs that have to be paid for by you, the consumer. So if you look at something like an appraisal fee, that's $650. That's an extra cost on top. That's usually around $650. Depends on where you're at, but $650 is pretty common. And then there's title insurance. So we have to make sure the loan is insured with title. Title is a completely different subject. Don't really have time to talk about it here, but it's an important subject to know. And then there's like the recording fee with the title company, messenger and courier fee, closing protection, recording fee, state stamps, transfer tax, prepaid interest, hazard insurance reserves, property tax reserves, and owner's title insurance. So as you can see here, these are all hazard insurance. You're prepaying for insurance. You're prepaying for some of your interest. You're prepaying for some of your property taxes. And so all of these are required from the lender unless you're putting something like 20% down. Other than that, pretty much all of these are required by the lender, have to be paid for. Now, they're not a huge cost, but depending on the amount of house you get, it does vary, because if you have to have a lot of if you have a lot of taxes and a lot of insurance cost, well, then those have to have reserves. And so then your closing costs are going to raise. So it's usually best to, especially for a first-time house, usually budget at least an additional $6,000 to $8,000 in these costs. Now, if you're going, again, the bigger the house, the bigger the closing costs might be. So you might have to bring even more than that. But that's usually a good range for a first-time home buyer, is $6,000 to $8,000 for all of these additional fees. So we've got the $7,500 plus, let's say, $8,000. So that's about $15,500 somebody needs for a house. Now, again, that cost can be gifted. So let's say your parents want to give you $15,000 for to be able to buy a house. Done right there, easy. Or let's say they just want to give you $5,000, and then you have to make up the extra $10,000. Also still doable. So, but it is a cost that does need to be accounted for and budgeted for, because let's also say, okay, my closing costs aren't actually $8,000. Great. Well, now you have that money saved just in case, instead of not having the money and then needing the money and, oh crap, where am I going to get the money? So now we go into different loan programs. Man, it took me forever to actually get to the actual loan programs. I've got about 10 minutes left. Maybe a little bit less, because I'm going to probably cut around 3 minutes of this out. So now we're going to look at the different 5 major loan types. There are more than this, but these are just kind of the main ones, bread and butter, where most of the population are going to fall into. And so first we're going to look at conventional. This requires 3% down and a minimum down payment. The loan size can be $510,000, and now it's actually greater than this. So this number is old. This number is actually as of 2019. In 2020, every county is going to be able to go up to $625,000. And then the high limit, I don't even know. I think it's in the mid 8s. But for El Paso County, the conventional loan limit is $625,000. Minimum credit score is a 620. that's required for a conventional, and then you can have this for pretty much any home purpose. This can be for a primary residence, it can be for a secondary house or investment. This is kind of the gold standard of loans. This is what everyone strives to get into because it usually has the least amount of additional cost or costs that don't go towards the loan in it. And so it's a very good option if you can get it. Again, the 3% down is a pretty sweet gig. And so that's something to note as well. I notice you can do 3% down on $625,000 house. That's pretty awesome. Now we look at FHA. Again, these loan limits are not updated as of 2022. These are as of 2019. So disregard those for now. But they can go up to a conventional loan limits depending on the area, but they're generally lower by about $200,000. I'm not sure if they've announced what their cap is going to be yet for 2022. I don't remember off the top of my head. But for an FHA house, it is 3.5% required, and then you have to have a 580 credit score minimum. Now, this is depending on the time of year and the conditions, because during COVID, this raised up to about a 620, but it is generally around a 580 minimum, and then the purpose is just for buying your primary residence. And now we look at jumbo loans. There's a 10% down payment required, and this is if there's even programs available for it. Loan size it's in the millions. Again, this is as of 2019, but it's in the millions. Credit score is you have to have at least a 680. 720 is preferable. So let's say you're going to become a doctor, you get a good job. This is usually a price range that is doable, and you can have this for any form of house, secondary, primary, investment as well. It's usually best for primary because that's where rates are best. Secondary investment have a lot more conditions on top of them. Now we look at USDA. For those who have the countryside, as you can see, this requires a 0% minimum down payment. The loan sizes again can go up to conventional, but they're usually around $200,000 less than the limit, so they're probably going to be around $400,000 come next year. 620 credit score minimum required, and you can only use it for a primary residence, and it has to be in a rural area. This is a loan that is literally done by the United States Department of Agriculture, and is a loan that requires you to be in what they consider a rural area. So now we look at a VA loan for those who have served. So for veterans, this is a loan for veterans. It's 0% down payment. There's actually no loan limit. In reality, the loan limit actually varies depending on company. And again, this is as of 2019, but you can get a jumbo-sized loan, as we talked about before, for VA. So in reality, there's no actual loan limit. And credit score, in reality, there's no actual minimum, but generally it's around 580 for most companies that is required for a loan. In a COVID environment, it's actually probably closer to 620, but it's not impossible to find somebody with a 580. And then home is usually you have to be buying it for a primary residence, and you can use the VA benefits on up to 2 different houses. So another thing we're going to talk about now is specific first-time home buyer products. So we're going to look at Home Ready, Home Possible, and then the CHFA bond program. So the Home Ready, Home Possible program is the conventional program where you can put 3% down, because traditionally on a conventional program, a person puts 5% down. But using Home Ready, Home Possible, a person can put 3% down, which is pretty awesome, like we talked about before. And then you have to have a 620 credit score at least for it. And the catch with it is there's so many pros for it. What's the catch? Well, the biggest catch is that there's area-specific income limits. So depending on the area you're buying in, there's a certain amount of money you can make. So like in Denver, it's around $80,000 that a person can make per year to qualify for this program. If you make over that threshold, it's too much. In El Paso County, it's around 69, I think, because it just recently updated, a high 60s that a person can make before they don't qualify for this program anymore. And then there's CHFA bond program. It is a program that's done through FHA, conventional, USDA, and VA. So through all the programs, and it's a person has to have at least $1,000 down. It requires a 620 credit score, and a person can have and this is where someone can get down payment assistance. So this is a down payment assistance program that a person can get up to 4% of the loan amount in down payment assistance. And so now when we break down, okay, how much debt can somebody take on with a certain program? Now, conventional is the 50-50. So when we talked about the $6,000 a person could use for a house, 50% of that, $3,000, can be used for buying a house, which allows a person to get $3,000 per month that they can pay for a house. This is different for every program, and not every program allows all of the person's debts to go towards a house. You can't have every single one of your debts go straight towards your house payment. That is allowed through conventional. FHA, however, the amount you can have for a house can only be, right now it's about 46%. These numbers change very frequently, which is why I keep having to say different numbers, because the numbers don't stay the same. Even this year, these numbers aren't the same from what they'd be. 46% is usually the maximum, with 56% being for all of your debt. So if you see these two fractions, the 50 to the 50%, the 36% shown on screen is how much of your debt can be for your house. And it's actually more like 46% depending on your credit score, but 36% is the minimum. And then 56% is the amount of your debt that can be for all of your expenses, for all of your debts. 56% of your income can be towards debt in general. USDA, here it says 45%. This has changed from 40 to 45% even within the year. VA, there's no technical limit to it. Many programs have it be 50%, 55%, depending on the place you go to get a loan, but there's no technical limit on the amount somebody can have in a VA loan. And then Home Ready, Home Possible that we talked about, the conventional program, is also a 50% maximum. And then CHFA, depending on the program you go with, is 50 to 56%, depending on if you use conventional, FHA, USD, or VA, depending on which a person goes with. So this is an important slide I wanted to have about what we can do with student loan debt when somebody's trying to buy a house. Now, deferred loans, so like right now that pretty much all of the country is going to have until January, and FHA loans all require 1% of the loan amount to be assumed that's what's going to be paid. VA won't count student loans if the student loans are in deferment. Conventional loans will assume whatever the credit report says. So let's say you're paying on your student loan debts and you have it established, oh, I'm paying $45 a month, whatever, for my student loans, then that's what the payment will be. Whereas if that's not the case, then we have to go off of, again, if it's a deferred loan, it has to be 1% of the loan amount has to be assumed if there's no agreed upon payment. Okay, so this is the end of my presentation. These are a couple of things to go through when it comes to getting a real estate agent. For now, we're going to end it here because this part is more so, it's better handled when actually talking to a real estate agent. Something we are going to note specifically when it comes to getting a loan type that I think is very important is we talked about the cost to go into a house. Part of insurance is not just insurance, but it's also mortgage insurance. And so if somebody's putting less than 20% down on a house, they have to pay what's known as mortgage insurance. And so the mortgage insurance is an extra cost put on top of all of these loans if you put down less than 20%. That's going to be done by conventional, that's going to be done by FHA, and that's going to be done by those two programs. Now, what you won't see is that for USDA or VA, they don't have mortgage insurance. Sorry, no, it's just VA that doesn't have mortgage insurance. USDA can. And then what's also important to note is for FHA, for government programs, you also will have something that's known as an upfront funding fee, which will be a percentage of the loan a person has to pay in a fee. Now, this can either be financed through the loan or it has to be paid upfront by the buyer. And so that's with government programs, but it's not done with a conventional loan. So something else to keep in mind when looking at loan programs. If you have any questions, again, feel free to contact me here. I'd love to talk to you, love to help. I love educating people. I just sat here for 45 minutes teaching, so it's something I do enjoy. And so it's something to just keep in mind, that always resource, but hope you enjoyed, hope this helped. It is a lot of information, so that's why it's recorded, so that you can reference it as you want. And then I want to thank the Reach Your Peak Scholarship for allowing me to put this together. I hope this helps all of the scholarship recipients, and I hope that it was informative. So again, any questions, feel free to contact me. I've been talking my throat dry, so I appreciate you watching, and have a great rest of your day.